Hey, what's going on guys? It's Martin here and welcome back to another YouTube video where today we're going to be talking about taxes in the stock market. Let's get right into it. In the stock market, you are taxed using something called capital gains tax.
Don't you have anything relevant to say?
Which in simple terms just means you are only taxed on the profit that you make from the sale of a stock. So let's say, for example, I buy a stock for $100, and after a certain period of time, I sell that same exact stock for $150. I've gained $50 in the sale of that stock. I would be gained on that $50 using capital gains tax. My original $100 I get to keep. Nobody gets to touch that. But I am taxed on my gains. Let's dig into that a little deeper. Let's say I'm a day trader that trades stocks every single day. I like to buy low and sell high on a daily basis. I am taxed on all of my gains day to day. So with the ease of investing with things like Robinhood, M1 Finance, and Webull, Coinbase, and all these other free brokerages and stock trading apps that are available online, day traders are becoming a lot more prevalent. People that are able to trade for free are doing it from their phones, computers, things like that, but they don't really necessarily realize how much they're being taxed. The way capital gains tax works is that if you hold a stock or an asset for more than a year, you're actually taxed at a lower rate. If you hold your asset or stock for less than a year, that's when it's taxed as regular income. So whatever the government pulls out, whatever is pulled out from every single one of your paychecks, percentage-wise for tax, will also be applied to whatever gains you receive in the stock market if you're holding that stock for less than 1 year. Now, what does that mean? Well, if you refer to my last couple videos, you'll know how we talked about short-term versus long-term investing. In the case of taxes, it kind of makes more sense to go with long-term investing because when you go to pull your money out, you'll actually be taxed a little bit less. Now, using the word tax doesn't make a ton of sense, but let me put it in perspective. The average amount of income tax in the US is about 26%. Now, obviously, a lot of people are paying a lot more than that, but it all depends on your tax bracket. So basically, the amount of money you make per year drops you into a certain bracket of people, and based on your income, the government will take a certain amount of money away from you percentage-wise. Now I'm going to put this chart up on the screen that shows you how much money you would make with long-term capital gains tax instead of the short-term regular income tax based on your income. So overall, keeping a stock for longer, specifically over a year, allows you to make and keep more of your profit. Now, then the question arises, what happens if you lose money in the stock market? Well, you can actually use those losses to counteract how much you're being taxed. So let's say this year I start off with $100 and a year from now I go and sell my shares for $200. So I have $100 in gains. But in the beginning of the year I also invested $50 in something and lost all of it. So I've technically over the last year invested 150, gained 100, but also lost 50. So instead of being taxed on the 100 and then also losing the 50, you can use that 50 that you lost to counteract your gains. So now you're only being taxed on the $50 difference between your $50 loss and your $100 gain versus being taxed on your $100 gain and then also losing another $50. Now, I don't know if that made a lot of sense. If it didn't, scroll back a little bit, rewatch that. But basically, you are only taxed on the stuff that you profit. Now, if you lose, your losses will cancel out your gains and you will only be taxed on your net profit. So, let's start at the beginning and kind of go over it one more time. Capital gains tax is only paid on realized gains after a stock or asset is sold. So you're only taxed if you gain money in some sort of stock or asset. Now, capital gains tax applies to a couple different things, but they're all very limited. This includes stocks, bonds, jewelry, real estate, and things like that, where you can invest in something and carry it for a long time and not lose a lot of money in depreciation and even make money. Now, the IRS has two different ways of taxing your gains, either long-term gains or short-term gains. Now, with long-term gains, you're taxed at a much lower rate if you hold it for over a year, whereas with your short-term gain, you are taxed as if that is money you brought in regularly through your job, so it will be taxed as regular income rather than at a lower tax bracket. Now, taxpayers can kind of offset their tax payments by using their losses against their gains to kind of bridge the gap and pay a little bit less taxes just because you're only paying taxes on your gains. I'm going to throw the chart up here just so you can take another look at, the different tax brackets and ways it's split up. You'll see it's mainly based on your income and your marital status. Most people that are teenagers or, young millennials, things like that, if you're single, you would be filing as single. And depending on how much money you're making If you're making between $40,000 and $441,000, you would fall into that 15% bracket. If you're making over $441,000 a year, you are taxed at 20%. But if you're making less than $40,000 a year, you pay $0 in taxes. So this is where your long-term investments really pay off. If you are not making a ton of money at the moment and you're investing in stocks and you hold your stock for over a year and you're making less than $40,000 a year, you have the opportunity to pay $0 in taxes on your gains. Now that is unbelievably powerful because any gains you make, if you keep your stock for over a year, that's all profit. Whatever price you see when you sell that stock is the amount of money that's going to go right back in your pocket. You don't have to pay any taxes on that money at the end of the year. If you have a job and you get a paycheck and you see how much money they've taken away because of taxes, you know what I mean when I say there is definitely value in not paying taxes on your money. Now if we take a look at this list again, there are still tax brackets where you wouldn't have to pay taxes if you're staying within a certain income level, whether you're the head of the household, married and filing jointly, or even married and filing separately. There are still income brackets where you can be taxed 0% for your capital gains over 1 year. Now obviously this doesn't apply if you're investing for less than a year, but at that point it is a personal decision to see if it's more valuable for you to make short-term gains and be taxed at a regular rate, or hold on a little bit, use those longer-term investing strategies that we talked about in past videos and end up having not to pay any taxes at all. And that's pretty much it. This was a super short video. I just wanted to get that idea out there so you guys had some sort of idea about the tax side of things, because that's a big thing that I had questions about when I got started, and I'm sure a lot of other people do. So just to clarify it, that was how you are being taxed on your stock gains and losses. I hope you guys enjoyed the video. Let me know if you have any questions down below in the comments, and yeah, I hope to see you guys soon.